Welcome to my discussion on how to prepare a spreadsheet and a cash flow statement using the direct method. In previous videos concerning cash flow, we've learned that you can isolate cash by looking at the change in other accounts, and if you find the change in all other accounts, you will find the change in cash. We also learned that you can prepare journal entries to determine the change in cash. These journal entries wouldn't be recorded, they would be used to explain the changes in the other accounts as they relate to cash. So we're going to use all that information to learn how to prepare a spreadsheet and then make a cash flow statement from that using the direct method. Notice I've given you some information from Dex Company, 2 years worth of balance sheets so you can calculate the change in the balance sheet accounts, and one income statement. You'll recall income statement accounts show the change in the account because they always begin with 0. And then I've given you additional information from the accounting records. If we had a general journal, I wouldn't need to give you additional information, but since we don't, we'll use this additional information to calculate the change in our accounts when we need it. Let's scroll down now and look at some instructions. The first thing we need to do is to prepare a spreadsheet. And the first section we'll complete is the cash flows from operations. Recall from previous discussions that things that affect operations are all the income statement accounts and the current assets and the current liabilities. Although there are a few exceptions to this, we won't incorporate those into this illustration. We might need to refer to additional information as needed if we have any gains or losses that need explanation. Once we've calculated the change in all the income statement accounts, we'll check to make sure we've captured every one of those accounts. So we'll check for completeness, and then we'll calculate we'll net all of those and calculate net cash flows from operating activities. So if you haven't already, please print these instructions and then consider following along with me. Let me bring up a spreadsheet now. To go ahead and move us along, make this a little quicker, notice I've entered all of the balance sheet data for 2012. And I've entered all the balance sheet data for 2013. Notice that the current assets and the assets and liabilities agree for 2012 and for 2013. And then I also entered all of the income statement items from 2013. I've done all of this just to make this go a little quicker, and then noticed at the bottom that I have made two totals, two at-sum calculations or functions happening right here to keep track of me as I go. Now I'm going to use this handy dandy worksheet to calculate the change in all accounts. And of course, I'm going to start with the income statement because our instructions said the first thing we were going to do was to calculate the change caused by the income statement by relating it to current assets and current liabilities. So let's start with the income statement. The first item on the income statement, sales revenue. Sales revenue would have a credit balance, so I'll enter a credit on my worksheet of 210. The account that changes with sales revenue on the balance sheet is, of course, accounts receivable. Our accounts receivable went from 48 to 24. It decreased by $24, so I'm going to enter a credit of $24. So I collected all of my sales, an additional $24, I know because accounts receivable went down, so I can come down under my cash flows from operations section of this worksheet and write cash from customers and finish my journal entry. Now I'm on journal entry number 1, and I received all of my sales plus an additional 24, so that will be $234 collected from customers. And look at my totals. They agree. Yay! Back to the income statement. Item number 2 on the income statement is dividend revenue. Dividend revenue also has a credit balance. So I'll enter a credit on my worksheet. Let's see if I have any receivables relating to that. Oh, look, I do. I started the year with 3, but it increased through the year by 1 to 4. So I need to incorporate that change in because it would change with dividends revenue. 3 plus 1 is 4. So that means although my revenue was 4, I didn't receive all of it. I still am owed 1. So 4 minus 1 is I must have received from dividends the difference, or 3. So my second transaction is to enter a debit of 3 cash inflows from dividends. Notice I'm still in balance. Back to the income statement. Cost of goods sold is next. It's an expense. I'll enter that on the debit side. It's transaction number 3 for my analysis, and it's 125. As you'll recall, accounts receivable or inventory to accounts payable change with cost of goods sold. Let's see what happened to inventory. Transaction number 3. What happened to inventory is it increased by 5. So I'll record a debit of 5 and show that go out. What happened to accounts payable? It went down by 4. It has a credit balance. Still on transaction 3. I'll show that going down by 4. 18 minus 4 is 14. So what do we have for number 3? A 5 and a 4, that's 9. On 125, that's 134. So I need to record that as a credit. Looks like I need to move that down a little bit. Cash outflows from operations, 134. We'll put that right there and say cash paid to suppliers is 134. What that means is that of my cost of goods sold 125, I also paid for all of that and added 5 more units or $5 more to inventory, and I paid even more than that. So I paid $4 down on my accounts payable. You can tell that it went down. So I stocked up on inventory, paid my accounts payable down a little bit, so the total paid to suppliers was 134. We need to put our 4 in there. I linked these transactions together with numbers, 3, so that if I get lost, I can go back to whichever number I was on when I was working and it doesn't balance. But look, I do balance. 372 debits and credits for totals. So going back to our income statement, the next item up is salaries expense. And we're on transaction number 4. Salaries expense, the change in that account would have been a debit for 27 for our list that. So I'll list that and I'll go up to the balance sheet and I'll look for anything that has to do with salaries. And I see salaries payable. It went from 4 to 1. Since this is a credit balance going down, I need to debit it for 3. I am on my 4th transaction. So I have a debit of 3, salaries payable going down. I have a debit of 27, salary expense. So paid to employees must be the sum of those. 24 plus 3 is 27. And I am on transaction 4, so I will come down and put a 4 and say I paid 27 to my employees. Ah, look, I don't balance. What happened? 3 and 27 is 30. So I have had a math error. I have I have salaries expense. Let's work it through of 27. That's a debit. And salaries payable of 3. That's a debit. 27 and 3 is 30. Ah, did you see that? By watching my totals, I caught immediately that I was out of balance. And if I didn't catch it immediately because I wasn't paying attention, I could go back through and link these numbers together by the reference numbers I'm leaving. The number 4 in this case. That worked well, didn't it? Depreciation expenses up next. Item number 5 is depreciation expense. It's a 4 on the income statement. The counterpart to that on the balance sheet would be accumulated depreciation, and I'm going to come up and put the 4 right there. No cash flow consequence to that, but still accounted for. Now I'm on number 6. Number 6 is interest expense of 6. This one's a little trickier. It messed me up and made me have to start this video over. Interest expense has a debit balance of 6, so I place that there, and I'm on 6. Ignore that. That's a coincidence. Is there an interest payable or an interest expense? And yes, there's an interest payable. It went from 3 to 5, so it increased by 2. So I need to record that. I'm on transaction 6. But there's one more thing you have to catch here. If you have a discount or a premium on bonds, that needs to be analyzed at the same time because that's part of the entry that records interest expense. And I have a discount on bonds. It went from a debit of 2 to a debit of 1. So the discount on my bonds payable needs to be credited. Now remember that discounts have a debit balance, and this one got smaller. I'm still on transaction 6. It went down by 1, so we have a 2 and a 1. That's 3. And we have an interest expense of 6 as a debit. Credit of 3, debit of 6. I need a credit of 3 to make this entry balance. Put a 6 here, and cash paid must have been 3. Cash paid, we'll just say paid for interest. To be consistent, paid for interest is 3. And when I get through, yes indeed, I'm still in balance. Nice. Let's move on down the income statement. A loss on the sale of building. Losses have a debit balance. I'm on transaction 7. So I'll get my 1 in. And now, how are you going to know how much the building was, how much cash you got, what accumulated depreciation was? The only answer is to visit the other data. Under our additional data, transaction or item number A says a building that cost $24,000 and was 3/4 depreciated. 3/4 of 24,000 is 18. Was sold for 5,000 cash. So 24, 18, and 5. Let's go back to our worksheet. Our buildings are going to go down. We're on transaction 7 by 24,000. So there goes our 24. It was depreciated by 3/4. Transaction 7. 3/4 of 24 is 18. I received cash. Cash received from the sale of a building would be under investing since it's an other asset. So I'll write sale of building. Now they told us it was 5, though I could have made a journal entry and figured that out. I'll record that. So we have 18, 19, and 5 is 24, and 24. That transaction's done. Yippee! All right, moving on. The next item on the income statement is income tax expense. Item number 8 is income tax expense. Expenses have a debit balance. I'll record that as a debit. Let's see if we have any income taxes payable and deferred taxes. I don't see any deferred taxes. I'd look at that now if I had it, but I do see an income tax payable. So I am on transaction 8, and my payable went down 1. That must mean it was debited, so I'll record a 1 there. And then I'll record my tax expense of 14. So paid for taxes must be the sum of those two. Paid for taxes is 1 and 14 or 15, and I am on transaction number 8. How did I do? Still in balance, and I've recorded the transaction for income tax expense. Now, net income is 37. This one's not quite as intuitive. Net income will be posted into retained earnings, item number 1. So I'll record it as an increase to retained earnings, and I do need to make my worksheet balance, so I'm just going to say that I need 37 in my debit column to make my debits and credits balance. And my total's equal. Now the next thing that it said to do on our income statement, it said when through with the income statement, check for completeness, and then enter net cash flows from operating activities. So let's see what that means. To be complete, I would have to have all my current assets and liabilities done and my income statement done. Let's check for completeness. Accounts receivable 48 minus 24 is 24. 3 plus 1 is 4. I'm just reading my way down. Inventory is 30 plus 5, 35. Long-term investments is not current, so dropping down to current liabilities. 18 minus 4 is 14. Salaries payable 4 minus 3 is 1. Interest payable 3 plus 2 is 5. Taxes payable 6 minus 1 is 5. And notes payable is long term. So I'm all right there. Let's see if I dealt with all my income statement items. Revenues, cost of goods sold, salary expense, depreciation expense, interest expense, building loss, income tax. Yep, I've got that 14 down. And net income to balance, and it's been recorded in retained earnings. It looks good. Now all I need to do for this section is to net the cash flows from operations, or this section right here. If I had a spreadsheet function open, I would do an at sum right now and come up with the cash flows from operatings. Let's do that. I've expanded my worksheet to show you what's in my cell. I'm adding D38 plus D39 and subtracting F42, 43, 44, 45, and 46. So it says my net cash flow from operating activities is 55, and as long as I've got all of these in this number, my spreadsheet is going to tie, so you need to be careful with that number. If you have a mistake and your totals down here agree, you probably have a mistake in one of your sums here, because we're going to add some operating, investing, and financing activities. So we're done with operations, and in an effort to keep these videos as short as I can so you can stand them, I'm going to finish up this video and do cash flows from investing and financing and show you how to make the cash flow statement on the next one. Thank you for joining me. Bye for now.